Hey, I'm Ben from Modern Graham, and today we are going to talk about BlackRock Inc. So be sure to stick around to see what I think of this company in the Modern Graham valuation system. So, first of all, we've got BlackRock. Ticker is BLK. Current price is SIPS 9201. The sector is financial services, and the industry is asset management. These items here are what I find to be most important on the balance sheet. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and outstanding shares. And all of those will come into play in the valuation. Over here, we have our chart showing the earnings per share and the dividends per share over the last, 25 years-ish. So we've got blue is the earnings per share. You can see that has pretty much been on a very steady rise, and dividends in red have definitely been on a very steady rise. Let's look at the detail. Over in here, we have the diluted earnings per share, and they are hugely improved from what they were in the 90s. So in 1999, for example, earnings per share was 104. Today, the estimated is 33.60. That's huge. This column here is the earnings per share Modern Graham, which is a weighted average of the last 5 years of earnings. We're putting the most weight on the current year and the least weight on 5 years ago. And that helps smooth out that business cycle so that we can see a little bit more trend in the earnings data. And here you can see that has gone up every single year on record here, which is very impressive. Even on the years where the earnings have dropped, like here in 2016, earnings went down, but the weighted average continued to rise. So that is very impressive. Dividends per share, you can see that has gone up very, very much as well. This has been a very hugely impressive dividend performer over the years. It did have 1 year in 2009, in the heart of the financial crisis. They did not grow their dividend. So that is a knock a tiny bit, but that is old enough that it is not going to play too much into our evaluation. Dividend yield has hovered between 1% and 3% the whole time. Dividend payout ratio has been about 30 or 40%, under 50% most years. And so that has been very steady. And that dividend growth has been very good, like I said. Now, moving on. Stage one is to determine if the company is suitable for the defensive investor or the enterprising investor. The defensive investor, remember, is somebody who is not willing to do a lot of research into individual companies. So they have a high level of requirements that a company must pass in order to be suitable. And here we have market cap over 2 billion. Yes. We have a current ratio over 2. Yes. We have positive earnings per share for 10 years. Yes. We have dividends for 10 years. Yes. We have an increase in earnings per share in the last 10 years. Yes. We have a PEMG under 20. No, we don't. This one, the PEMG, the price to earnings ratio using the weighted average for earnings, the ratio is 20.82. So it just barely fails that. And a price to book ratio under 2.5, it fails that too. Right now the price to book is 2.8, and the alternative way of passing this is to take the price to book times the PEMG, and if that is less than 50, then it would pass, but here it does not, so it fails. So it only gets 5 out of the 7 for the defensive investor, and it fails. So then we look at it for the enterprising investor. The enterprising investor is willing to go to further research and go dive into an individual company to determine if it would be suitable for them, but they have their 5 tests to start with. And here we have current ratio over 1.5, yes. We have debt to net current assets under 1.1, correct. We have 5 years of positive earnings and a dividend, and the earnings per share have grown. So we get a 5-point score for the enterprising investor. Now, if you are enjoying this video and you enjoy my content, please take a moment to like this video, subscribe to the channel, and when the video is over, click to download a free valuation calculator so that you can continue to do valuations on your own. Stage 2 is to determine the intrinsic value of the company. And remember that the intrinsic value is not the same as what the market is willing to pay. And so we want to go in and try to figure out what the company is worth in order to determine if the market price is a good price at the moment. And to do that, we use the formula that Benjamin Graham taught in his book, The Intelligent Investor. And remember, Benjamin Graham is the person who taught Warren Buffett how to invest. So his formula was value equals earnings per share times 8.5 plus 2 times the growth rate. And I've updated that to use the weighted value for the earnings per share. So we have two variables. We have to figure out the earnings per share and the growth rate. The earnings per share, again, is a 5-year weighted average. We get 33.24. And to get growth, we take that figure and the figure from 5 years ago. We calculate a total growth of 35.55%. We divide that by 5 to get an average growth of 7.11%. And then we have a safety margin here. Because growth is such an important factor in this formula, if you overestimate growth, you can see it's a multiple twice over. So it multiplies here. You go 2 times that growth rate, and then you multiply it times the earnings. And so it's a key variable. You don't want to overestimate, so we have a safety margin there and cap the growth rate, in this case, at 5.33%. Plugging that into the formula, we get a value of $636.90, which is less than the current price of $692.01. And with this very handy chart over here, you can see that the value is lower than the price. So that one, right now, it gives a fairly valued rating in my system, because that is any company that is valued between 75% price to value and 110% price to value. So it's in that fair value range. Other ways of looking at this, if you put that price, the current price, up here in the formula and then solve for growth, you get a growth rate. The implied growth rate is 6.16%. So if you think the company is going to grow more than that, then that may be a way to see that the company is currently undervalued by the market. If you think it will grow less than that, then it would be overvalued. Coming down here to the modern Graham grade, which takes into account other factors as well, we get 1.5 points for being suitable for the enterprising investor. We get 0.5 point for being fairly valued. No points for it's not trading below its Graham number. It has not had long-term dividend growth because it had that 1 year that it did not quite grow the dividend. And the dividend yield is currently above 2%, which gives us a 0.5 point there. And it is not trading below its NCAV or the industry average, PEMG. So total score is 2.5, which is a C+ grade. Stage 3 is further research. If you've gotten to this point and you've decided that the company is suitable for your investor type and that it is a value that you want to pursue further, then it is time for you to decide if the company is suitable for your individual portfolio. You have to do that. You know your investing goals. You know your diversification needs. So it is time for doing further research if you deem it worthy. Net current asset value, that would be a floor to your value. That is the amount left over after the company takes its cash and pays off everything it owes. And here it's negative, so it doesn't really apply. But a Graham number. The Graham number is a formula that is derived from those defensive investor requirements, and a lot of people like to use this as another way to look at value. Here it is 432, which again is not, it's below the price, so according to that, it is not below its Graham number. Price to earnings ratio, like I said, is 20.82 currently. Current ratio is 10.01. The price to book is 2.8. Dividend yield is currently 2.84%, and it has 13 years of dividend growth. Moving on to stage 4, if you've gotten to this point and you do want to pursue further, now would be a time to look at the chart to determine how to maximize your profits. Because even though we don't want to value a company by looking at the chart, we can use that as insight to what the market is doing and whether or not it is a good time to enter a position. And in this case, we can see the blue trend line here is a long-term trend line going back for a long time. And it broke above that recently in July. And it came up and then it hit a couple of resistance points and came back down and kind of came back close to that trend line. Not quite at the same spot. Oh, no, wait, here. It did. In October of this year, it went back and it tested that trend line. And then it came back up. And so then the market decided that that trend line might not apply anymore, and it brought it up higher. But then it hit these green lines are various support and resistance lines that have developed on the chart. You can see it came up here and it stalled. It had a higher high than it had here, which is good to see, but then it couldn't surpass about where this was. So then it came back down. It fell through the support that had just been established, and now it's come back down to this line here, which is an interesting point. If it turns around, then it might come back up to 755. If it fails here, it might come back down even further. So then down here we have the relative strength index, and that shows the momentum in the stock. And you can see that a couple of things of note here. One, when a company falls below 30 on that, it would indicate that the company is in a bear market trend. And it was in that for a while. But this one in particular, it broke above that, which would indicate a bull market trend. But then it came right back down and it fell below 30 again. So, and then it came back up and it surpassed 70 again. So that would indicate to me that perhaps we're entering a window here, that maybe it's going to come up here and then it'll come back down. It might come back to the trend line again, or it might come and start to establish a support level here, in which case it might have an up and down in a range, and you might want to pay attention to where it turns around here if you are looking to enter. But again, that is it for today, or that's it for this valuation. Click on the video on the screen now. It will be another great video that you will enjoy as well. Thanks for watching, and I will catch you next time. Take care.